Hello and good evening from Optimize Accountants. I'm Louise Mishevich.
And I'm Simon Mishevich.
Hello. Tonight is another wonderful night all about tax. Now, don't start groaning because genuinely we're going to bust some myths about tax. We're going to give you some tax ideas, tax savings and efficiencies. What else are we going to be doing?
Well, we're going to turn off the volume on my iPad for a start.
Excellent news.
So we're a professional show here.
We are.
Yes.
We is.
So, good evening and welcome. If you have any questions, then make sure that you use the chat box, whatever stream you're using, whether you're on LinkedIn, Facebook, Twitter, YouTube. Ask a question and we'll ignore it.
We will not.
Oh, sorry. We
will be most definitely best to get through as many as we can.
We are like typical accountants. We'll respond to you back in never. Right. So if you've got any questions, feel free to send those questions over to us. But what we will do is, as normal, we will go straight into the detail. And tonight, Louise, I have a special surprise. Whether we get this to work or not is a tax return. If you wanted to go into sections, maybe we can share it.
Hooray.
Okay.
Everything you've ever wanted, I know.
I know. I will do my best.
Because I do like self-assessments. I'm not sure you're aware of that, but I love self-assessment tax regime and helping people get it right and make sure they're paying just the right amount of tax, not too much. I feel like Goldilocks and the Three Bears.
Not too little that you are investigated,
just
though, right?
the right amount.
Which is really the key part of all of this. So let's get into the first question because Aidan's asked a question.
Hello, Aidan.
Share the question. Can I ask a property question? FHA. Yes, that is a live show, so you can ask us a tax question.
Go for it. We're ready.
Don't ask personal questions because you might get the wrong answer. So I'll show
Daddy
you.
or chips? That's a very important question.
So the question is, Aidan is so hi Aidan, if you're watching in, I'm hoping you are. I'm looking to purchase a property that has some extra land next to it.
Hooray.
Purchase will be under my limited company name. I'm looking to split the title.
Hooray.
Convert the property into HMO and land transferred into my personal name with intention to building a house for myself on it.
Hooray.
What are the legal planning and tax implication of this? Shall I split during the purchase or after? So what's your thoughts on this one?
We do see this on a regular basis, not necessarily for the outcome you're anticipating, i.e. to keep both and one as your home, but we do see the opportunity of title splitting and whether to buy inside a limited company or in your personal name or attempt to title split at the time of purchase. And I would say the latter could be quite advantageous, particularly if, for example, the land is worth less than £40,000 and you do need quality survey reporting. You can't just finger in the air and go for it. But if the value of the land is less than £40,000 as it stands today, then potentially having that split directly at purchase into your name might mean there's no stamp duty land tax to pay at all on that purchase, ka-ching. The stamp duty land tax would then fall on the portion of the purchase that is the HMO suitable property. So you're doing your best to minimize your tax. If you end up having to buy everything in one place and then title split and then potentially sell, so to speak, part of the asset, then actually what you want to do is you want to think about which part of the asset is going to be worth the least at title split stage and move that. So again, if it is the land that's the lowest value, perhaps you buy everything into the limited company and then at title split move the land over, because of course that will trigger obviously additional SDLT, and we're looking to minimize that for you. Or actually, if ultimately it is the property that's worth the least, I don't know how much land there is, Aidan, so forgive me, you might be talking about acres, or you might be talking about a fraction of an acre, I don't know. If the property is worth the least, then perhaps buy everything in your personal name and move the property. But ideally, I'd want to be splitting at the point of purchase so you get maximum bang for buck.
There's just a couple of cautionary issues here. Is the fact that you potentially using a mortgage or financing, and they could take umbrage if you're trying to split title purchase during the purchase or even afterwards. So make sure that you speak to your advisor in terms of tax, but also you need to speak to your mortgage broker as well to make sure you don't scupper up any finances. But I don't think there's anything more to add to that. Whilst I'm just going to get rid of that for a question now. What's happening behind us, Louise? Because it's all empty.
Well, we haven't been raided. Please don't worry. All of our wonderful tax books and accounting books are still with us. But we've packed them away. And we've packed them away into boxes that are going hopefully on a van very soon to a new location. So our studio is moving. Where's it moving to?
It is moving to Marbella.
That would be in Spain.
That'll be
just in
Spain.
case.
So interesting enough, we always say do things in the most tax efficient way. Actually, we're going to be paying more tax in Spain than the UK. So listen to us for tax advice because we can't give it to you clearly. So we are going for the sun. And it brings an interesting point that people do things just for tax reasons.
Don't let the tax tail wag the dog.
Yeah, absolutely. And I do. And the reason why I highlighted that point is exactly that, is to make sure that you do things for the right reasons, not just for taxation, tax savings. Okay, I'm just going to go into a live question. So let's have a look at this live question.
We like live.
So here we are. So you're going to have to read it because my eyes are a bit funny. I've had a bit of a straw day.
Okay, so quick question. I love these. They're never quick questions, but that's the problem. We like all questions. I used the Green Grants Home Scheme to insulate the external walls of a rental property. Is this classed as revenue or capital expenditure? That is a lovely question. More often than not, if you in particular read the guidance provided by HMRC, and let's not forget, HMRC guidance more often than not is reviewing tax law, and they are assessing it just as we are, you are, anybody else is, so they get it wrong. But typically where an asset is improved and the improvement is likely to be retained on the property for 2 or more years, then it's highly likely it will be capital in nature, which means the only time that you can use it to minimize your tax is at the point of selling the asset and use it to minimize your capital gain, which of course then triggers your capital gains tax. If, however, it's classified as a thing that will last less than 2 years, then it's highly likely it will be classified as a revenue expense, and you can use that expense to set against any rental profits in the year in which the expense was incurred. From what you've said, and I could be reading more into this than there is, it sounds like external fixed permanent cladding. And to me, that's likely to last more than 2 years. I'm sure you're hoping it is based on what you probably paid for it, and therefore it will be capital. Simon.
Nothing more to add to it. I think, again, there were a couple of things on it. Is you mentioned that there's a grants home scheme, which could potentially taxable, depending on which way that the grant is set up. So you do need to be aware of that. Don't forget that some grants are given tax-free, some are actually taxable, especially when it's for property. Now, normally if it's for your home, it isn't taxable, but make sure that whoever's done that for you, that grant, that you get that legislation from them to understand if it's indeed taxable or not.
And when Simon describes a grant, which is a great point, because I'm thinking about you've expended money on purchasing these particular insulation panels or insulation products. But actually, if what you've done is secured a grant to pay for that, Simon is absolutely right, that you just need to check the fine print in case, and it's not all the time by any stretch of imagination, but in case the grant has to be described as almost the equivalent of rental income in your annual calculation of tax. So that's how it might be factored into a calculation. It's rare with grants, but it's worth double checking it.
I think what will happen from the grants that I've been involved with in different organisations is that you normally have a capital cost, but the grant will then contra that, so you don't get a capital uplift, which basically means that you got it at a nil cost. But there isn't any tax implications either. But some grants can be very, very different in terms of the way that they're treated. So just get advice on that one.
Sorry, it wasn't a quick answer to your quick question. Sorry.
Never is. It's always an interesting one on that one.
It is.
Let's go to Jane now. Jane's asked a question. So let's go over to Jane here.
Hello, Jane.
So Jane pledging, property developer looking to understand most tax efficient ways to structure a company. As a husband and wife team, like us, Can't see my hands. There we go. That's just
It's rude to
ignorant.
point.
That's just ignorant now.
It's
isn't it?
very rude
pointing.
to point.
Yeah. As long as it wasn't in the eye.
Oh, yes.
That's the main thing.
Ideally.
Okay. So what's the best way to structure ourselves within the company or companies? And that's a great question, because you mentioned property developer. What happens if you want to be a property developer and a property investor?
What happens if you start out as a property developer but come across something you just can't let go of and become an investor?
What if you were an investor, the deal was so good, someone wanted to buy it off you straight away?
And you became a property developer. I'm so sorry. We're going down a very different rabbit hole there, Jane. So sorry.
But the reason why we're kind of doing this and making fun of it is because it can change. Your plans can change. Yeah.
We've seen it frequently with our clients. I'm absolutely selling this, Louise. I'm absolutely selling it. I'm keeping it, and vice versa.
So you need a structure that is adaptable. Now, what I tend to say to people on this is a holding company, I was against them for many moons. Phraseology here today. Moons. Yes, I could be howling my way to this answer. Oh dear. I know my jokes are barking. Right. So
claw your way out. Claw your way out.
Yes, absolutely. Quite hairy, some of them.
So sorry.
So let me begin on this one. So think about holding company structures, whereby imagine a triangle, if you will. So at the top, I always want to say the word apex. Now I'll keep remembering about apex splitters. It's just not the same.
Move on.
Let's please move on. So let's have this triangle. Just imagine what this triangle looks like. And at the top, you could have your holding company, and then underneath that, you could have a trade business and an investment business. Now, I used to say to people, even my tax advisors will pull me up and say, well, 2 years ago you said this. And I always think, yes, I did. There's a good reason for then, but things have changed. I used to say, have a holding company in your own name for property development, as in trade, flipping properties, etc. And then have another holding company for your investments. And then underneath that, you might have joint venture partners, etc. Now I'm thinking, well, actually, why not have one holding company at the top? And there's very good reason for that. One, when I talked about having all these complex structures in place without the triangle, I was thinking about inheritance tax. I was thinking about entrepreneurs relief, thinking about business asset disposal relief, which is connected to entrepreneurs relief. Now I'm thinking, well, actually, people want life simple. Simple, Simon. Here go me. Simple, not Simon. So from that perspective, you could easily have that. You could easily have this triangle whereby you have a holding company and it has a trade company and investment company. Why is that important for me to share that with you? Is because you want to flow money from the holding company down to the property flip company. That property, if you decide to keep it, you could transfer that property development to your investment if you want to kind of reduce the number of companies you have. If you want to do loans from one company to another without giving yourself consideration on entrepreneurs relief, business asset disposal relief, you could just create a loan or move money up in with dividends to the holding company and then back down again. And that allows you then to all these SPVs very nice and clean. Now, when it comes to inheritance tax, you do have to think about, well, how was my assets? Because when it's trade purposes, as in property flips, a trade, it could be exempt from inheritance tax if you structure it correctly, but an investment company will always be subject to inheritance tax. So as you can well imagine, I've said an awful lot, and I haven't even got started on some of the other disadvantages and advantages that will be open to you. So I would always say to people, when you're getting started in property, think about you, your parents, your children, how you can all get involved, using freezer growth shares to mitigate income tax, to mitigate capital gains tax, mitigate inheritance tax, using limited company structures. They're never easy to understand. And even if I spoke for an hour on here, I still wouldn't get a solution. Well, not for you. And I mean, not for you generally. So anything to
very specific. The only thing that jumps to my mind, and Jane, I'm so sorry if we've just blown your mind and sent you over the edge, but you might be thinking, well, it's all very well and good saying all these holding companies and different companies beneath. I just want to get started. And I understand that. What I would say to you is, it is very hard to put a holding company company in place above an already active business, whether it be a development business or an investment business. Start with the end in mind. Think about the bigger picture. And then, yes, you can add lots of additional companies as and when you need them. Ideally, the fewer the better for administration and sleeping at night, worrying about what next deadline is there. But really, really get under the skin of actually, is a holding structure going to help you based on your bigger term plans? And if so, get that going from day one, perhaps with just one holding company at the top and one child company beneath that holding company to be started. But don't skimp on this phase, because if you do, you'll regret it. It will take perhaps weeks, if not months, to correct the structure, never mind all the untold cost and misery you'll have to go through in terms of administration to put it right if you realize it's wrong. So just spend a little more time at this stage. You're asking the right questions, keep going. And if you need some tax advice, well, we happen to know a company, don't we, that can help. But equally, if your own tax advisors already, go and have those quality questions and answer sessions with them now.
Good answer. Let's go over. I know that there are a couple of people asking questions live, and it's great to see. So
awesome.
I will get
We're going to come to those. By the way, if you're on YouTube, what would we like people to do?
Give us money. Oh, sorry, what?
Oh, please subscribe. We know that about 85% of people who watch us on YouTube aren't yet subscribed. They're not hearing about the next great videos we're bringing out. So if you're there, please do, and please also hit that like button.
I've just done that.
We'd love to have lots of likes, assuming you like what we're saying, of course.
Yes. Really, just to emphasize on that point, please do subscribe right now. And not as just that, but if you know someone, who is that one person that you think could benefit from this, please send this link to them now or tomorrow, because it will be recorded and they can watch it at a later date. So anyone that you feel that it could be, beneficial to, please do send it. It'd be great for them, great for us. Thank you. So Mark has said, I have become a compliant deal sourcer and set up a new company called VIP Property Club.
Done you.
Nice name. But we want to keep some deals and JVs with others. I'm keen to set up in the right way, tax point of view. And to be fair, Mark, I think whatever I've just said to one of the previous Jane, listen to that. I don't think there's much more you can add to that.
No.
What I would add to that, though, if you talk about JVs, when you are getting tax advice, they also need to get their own tax advice, because what might work for you may not work for others. It's a bit like when you go on Facebook and you say, someone says, oh, you really should do this. And then you go ahead and do it. And it's the worst thing you've ever done. And then you hate that person forever. Well, that's a bit strong. But, but maybe. But, you do need to think about the advice that's been given by an individual could work perfectly for them. But does it work for you? And could it work for your JV partner?
Their personal circumstances, their long-term plans could be very different to yours. So don't rely on the fact that simply it worked for them, so it must be right for you, and vice versa.
Let's just go to a live question, because there's quite a few, and I want to get to those questions. Here we go. So this is Bavish, I think it is.
Hello, Bavish.
Bavish. Hi. If I purchase commercial investment with family members and make my sisters directors, can the company contribute £40,000 worth of pension to each, assuming a total net is 80,000 nil tax? I think there is some concerns around that from HMRC. So, whereby you are right, you can make contributions to people's pensions, but actually they need to be active. And directorships, well, there are legal considerations here. So, as a director, typically HMRC will say, well, how much they're getting paid? What do they do? They are now going to be legally responsible for something the company does, and if it goes wrong, they are going to be in court
and held accountable for it.
Yeah,
and that's fine if they understand those responsibilities and they already perhaps enact those for other business. That's great. One of the things that HMRC, I think, are starting to get quite hot on is if you are giving certain types of benefit to your employees stroke directors, it has to be commensurate with the services they're providing to that business. So to go to the extent, let's say, of no salary, no dividends, but 40k of profits to each director's pension pot each year, it could raise quite a number of questions with HMRC, and you might have to have some very qualified and robust evidence to understand why 40k to each director is basically commensurate with the services they're providing. If you can provide that, fantastic. If you can't, then you just need to be a little careful of your planning.
A lot careful. Okay, let's go into the other questions that we've got. Onto a question that we've got here, actually. This is someone who's booked in earlier, so let's just get into this. Martin, it's
Hi, Martin.
deed of trust. What can my wife and I claim against our tax liability? My wife inherited the property with her sister-in-law. We bought her half, so therefore I'm assuming they got all of it.
Yeah.
At lengthy court case, I'm sorry to hear that, but debts and spent in the region on 40,000 in refurbishment. And let's just highlight the word 40,000 word in refurbishment, because Louise, this is your territory.
Oh, I love this kind of question, Martin. So the first answer I'm going to give you is probably a little bit like a politician. It's going to hide everything, tell you nothing, but
and lie. Oh, sorry.
No, I don't do that.
Politicians.
I'm not going to do
just
that.
General. Yeah.
But most expenses you incur on a business, whether it be a property business or a different business, are going to help minimize your tax. The important question is basically, at what point in the life of the business or the business asset will it help on the tax? Typically, items divide into either a pot called revenue or a pot called capital. There we go. My technical phraseology for the night, pots. We like pots. If it's a capital item, then it's going to help you at the point of asset sale or closure of business or sale of business. If it's a revenue item, it's going to help minimize your ongoing annual taxes, such as either income tax if it's in your personal name, or corporation tax if it's a limited company. So there's my quick canter through a summation. And I'm so sorry if that's already really obvious to you, Martin. But with your questions, what we need to understand for each type of expense you've incurred is which of those two pots it sits in. Typically, refurbishment, I'm going to jump on this one because there's a nice juicy number for me to work with. £40,000 of refurbishment. Now, it's all in the definition. If by refurbishment you mean repair, replace, or renew, so all those lovely words starting with re, then they're likely to be revenue, also starting with re, which means it will help minimize your in-year tax. And like I said, income tax or corporation tax, depending upon how the asset is owned. If it's something such as putting in place brand spanking new things, I don't know, an extension, let's say, or converting the loft to a bedroom, then unfortunately expenses are classified as capital. And it's highly likely that the work that's been done that you're calling refurbishment is a combination of capital and revenue items. And so it's critical that you now work through those expenses to understand which fall into which pot. So I appreciate I've only jumped on one of those types of expense that you've picked up, but you now need to work through all the different expenses you've incurred and work out which pot they sit in. Hoping that's helped.
And one big important factor here is, would it be useful if a builder gave a receipt or an invoice that says refurbishment, £40,000?
Horrific.
Why?
Because we don't know which bits are revenue and which bits are capital.
But it happens a lot, doesn't it?
It happens all the time. I was speaking to a client today who is currently scratching his head a year and a half after the work, £37,500 worth of expense, and trying to get the builder to engage with him to understand the split. And at that point, the builder has moved on multiple times onto new jobs, has already got the money, and has no real impetus to help to clarify.
Yeah, pretty tragic.
It is.
So let's go to this question, which I think is an interest. I will come back to your live questions in a second, guys, so don't worry.
Keep loading them to us. We're ready.
We're ready. We haven't got that many to go on these, so let's crack on and finish this one.
Max, hi, Max.
What options are available for minimizing inheritance tax on my estate?
Oh my gosh. We're going to be here all night, all tomorrow, and for the rest of the summer holidays.
Yeah.
Is that okay, Max?
And Max, I have purposely left off the numbers that you spoke about on the message, just for confidentiality. But let's start with the basics here. It is possible to have a lifetime inheritance amount of
£325,000 called your nil rate band, which is expanded up to a further £175,000 for residential nil rate band, meaning a total of £500,000.
If your home is what value? More than the 325,000.
Yes, but less than, or your entire estate less than 2 million.
2 million. Yeah. But in terms of how you reduce it, normally I would say the most basic ways of doing that is either you accept that you have got an IHT liability and you get life insurance, because that's sometimes the easiest way to pay off IHT, and you keep all the assets to yourself. But you can give away assets. You can do by gift.
So you can do something called a pet, potentially exempt transfer.
A dog, cat, camel.
Not that kind of pet. A pet is based, not that one either. A pet is typically giving away either money or assets to perhaps family members or friends. But the important thing you've got to bear in mind is that you really need to live at least 7 years after the gift to make sure that it cannot be back into the calculation of your inheritance tax death estate. And secondly, just because you're giving away something, perhaps it's something other than cash, perhaps shares or an asset such as a property, be wary that you could immediately be triggering capital gains tax on the movement of the asset. And that's because of a very nasty piece of law in the Capital Gains Tax Act that talks about connected persons. So the moment that you're giving something away to a connected person, typically lineal family, parents, children, grandparents, their children, etc., their calculation of capital gains tax falls based upon the market value of the asset on the day you give it. How lovely.
Interesting.
So just beware.
Yeah.
And the final thing I would say is there's lots of exemptions to inheritance tax, and make sure you understand them. So we did comment about it for Jane. Trading assets, so trading companies, are likely to benefit from being excluded from the inheritance tax death estate calculations, as might be trading share ownership. So if you have a portfolio of shares, you've had them for X period of time, there's a particular period you have to be aware of conditions wise, and they are all in trading businesses, then potentially you might find yourself in a great place being able to ignore those from your inheritance tax estate calculations.
The alternative is that you could be like one of our old clients who's now left us, Jackie Edwards. She just rents rent.
She's amazing.
She's a genius. Yeah, so she's a lovely person, I have to say. She still refers clients to her, so it's not as though she's left us and thought it was rubbish.
She's never escaped.
But she once upon a time talked about having alpacas on her land. So she had alpacas, which becomes technically you could have agricultural, which means that you can get partial exemption on your land as well. Debt, don't forget that debt also reduces the net asset value of your estate, which means you pay less inheritance tax. So I always say to people, when you and Americans talk about this a lot actually when they're doing the kind of American tax, but raise debt as much as possible, because the debt is not a taxable income, and it also reduces your inheritance tax. Now people want to reduce your I've got connection issue. You're back. I will find out in a second. So that basically you can get a reduction in inheritance tax by raising debt on your portfolio. I've just noticed my streaming has gone pretty slow, and I look a bit very pixelated, which
that's how he looks in real life, people.
Yeah, I am on that film Pixels. So let's move on. Hopefully our broadband connection has picked up again. Let's go on to Rex.
Hello, Rex.
Rex, I have a limited company. Let's just put it on there so everyone else can see, shall we?
Go on.
Let's just share. Let's share the love. Okay, here we go. Okay. So I have a limited company, but the property are in some names. Do we pay tax through the company or through a personal tax? And what is the best? Now we talked about, crikey, how many tax structures that we spoke about today. It's
I
an
know.
awful lot.
We've got lots more to go, people.
Lots more to go. But I have a limited company, but the property are in my personal name. Well, if that's the case, then the property and the income will be in your name, which means you pay tax on self-assessment, don't you, Louise?
Yes. So it has to, if you own the asset in your personal name, then you need to present in your personal name. There used to be all sorts of rent-to-rent schemes that people talked about. They fall foul of a nasty piece of law. I keep talking about nasty pieces of law, don't I? Called the General Anti-Abuse Rule, also known as GAR for short. There we go. Everything you've ever needed to know about GAR. As a consequence, anybody who is looking to do a rent-to-rent whereby you own the asset yourself personally, but you technically rent it to your limited company and the limited company makes lots of money in it, really, you should not be doing that now. There are a small number of instances where it's still possible and feasible to not fall inside the remit of GAR in doing so, but they are very rare, 1 in 100 at best. And so what I would say to you is if you own the asset personally, you're renting it personally, then you have to show it in your personal tax return. And sadly, the limited company has no chance of having a look in on it really from that angle.
Yeah. And I'm going to be doing a video, funny enough, talking about this, where the court case had gone against a landlord who used a limited company to siphon off profits because their accountant advised them to do that. Using the rent to rent, which is something that we talked about years and years ago in 2013-14, but we could see what GAR was all about and said people should unravel that. I'm still looking at the camera on my right hand side where we are, and we still look like we are a video game off the ZX Spectrum with all the pixelation. I feel like I'm on Minecraft.
It's doing wonders for my wrinkles.
Yeah, I'm
very happy.
So apologies for all that, guys, if but our broadband we will shall. Right, just eavesdrop. So let's go.
Should we see if there's any live questions we can jump on?
Yeah, shall we do that?
There must be some live questions, people.
Okay,
something you're burning to
here we
ask.
go. So here's one for us both to talk about. On
Leah.
Leah. On intercompany loans, Liz asked, between trading and property investment limited company, would you be able to close down the trading company without the loan being repaid by the investment company? You can, but there'll be huge tax consequences for you being counters out there, which there's very few of us. But you have debits and credits. Boring. But those debits credits still need to balance out. They need to net off. Still boring. What does this really mean, though? Well, ultimately, the debt will come off the balance sheet of that asset and has to be pushed through to the profit and loss, and potentially could be a taxable profit on the write-off of that loan for one company, and it could be then a kind of a cost to the company writing off that loan. That could be quite a dangerous thing to do. So I wouldn't do that. And that's one of the reasons why I talked about I don't like intercompany loans as much nowadays, because it does mean that people are keeping companies open because of these loans that exist. So rather than do loans, what you could do is have a holding company structure in place, move the profits from the first company up to the mothership, if you like, and then the mothership then puts it down again to the investment company, and you've got no loans at all to worry about.
Exactly. The one thing I would say is don't get too stressed about the way it's described. I think the best way to think about it is if you are thinking of closing a company that is owed money, there's a potential you can still do it. The problem is the value of debt that's owed is going to be treated on the company that owns the debt or is receiving the debt as likely a profit. So all of a sudden you're going to find yourself in the company that no longer has to pay back that debt and is whooping with joy. Actually, that debt now becomes like a profit and it triggers corporation tax. It's not pleasant. So really only go down that route if you have to. And on non-tax related point, I've seen situations where clients have been, for a whole host of very genuine, important reasons, Leah, and I'm sure that it's no different for you, where they've had to do that process. And then the directors of that company have had some real credit issues as a consequence because it's perceived that that business hasn't performed well under their stewardship. So you need to think about the bigger ramifications on this, not just tax. And I'm not going to go into any more than that because it hasn't happened in every single case I've seen, but there have been some issues and it's been connected to that issue.
Great question. So let's just get rid of that for a second. If you are joining us live tonight and this is the first time you've joined us, welcome to Mr. Minecraft and Ms. Minecraft, because our broadband is pretty shocking and we look like a pixelized version of Pac-Man. So apologies for that. Normally we do have a good broadband connection, but they know we're leaving, you see, so they're just dumbed us down into the service that they're providing.
It's doing airbrushing. Yeah. Airbrushing is doing an amazing job on me, so I'm happy.
But if you like this content, why not subscribe?
Why not hit the like button?
Yes,
go for it.
And share this. You know, if you do know one person, again, as I said before, what one person do you know, or which person do you know will benefit from this show? Watching some sort of tax program on Minecraft. Okay, so
moving on. Next question.
Let's go on to the next. So Sandra.
Hello, Sandra.
Asking the question here. I'm not even showing it.
Shocking.
Let's do it now. I would like to gift a property to my adult daughter, mortgage free, and she will then live in the property in London. How can I limit the CGT as there is a substantial gain? So first off the bat, what I would ask you to do, think about, well, how long have you lived in that property? Because you don't always pay capital gains tax on all of the gain. You might have something called
principal private residence relief.
Do you call it that? I call it private residence relief. Oh, interesting. Okay, so you either way, it's PR.
PPR.
It's even I get PRR, you PPR. It's weird how people do it differently. There's no right. I'm probably wrong. I'm not wrong. You're wrong. So let's think about that. So that means the time you've lived in the property means you do not pay capital gains tax on that portion of time. There is a danger that you gift your asset, and you said mortgage free. As long as it's a gift, there's no stamp duty and tax. Just quickly get that out of the way. But CGT, it will be based on market value versus what you bought it at. So
because of that nasty connected persons rules. And I'm reading from this, Sandra, and I might be reading more into it than there is, that actually it's never been your home and therefore you wouldn't get the PPRR relief that we've just described. And if that's the case, then I think you need to go and explore some of our articles, particularly how to use trusts to move assets around, because there is a cracking way. If you are gifting an asset that's unencumbered and would trigger capital gains tax otherwise, there's a cracking way to move that asset to your family and loved ones without it triggering that capital gains tax. Now, what you have to recall, of course, is that back to that wonderful inheritance tax point, when you do gift an asset, you've got to survive at least 7 years after the gift to ensure it doesn't form part of your inheritance tax death estate and trigger inheritance tax on your estate. So just be mindful that you need to plan these things carefully, meticulously, and in plenty of time. Not that we all know when we're going, and hopefully that's not the case here, but actually you're planning in lots of quality time to make sure that these assets can't trigger those nasty things for you.
Did you talk about trust?
I did.
Yeah, good. So I've been concentrating on the Minecraft pixelation, trying to see if I can.
Well,
get rid
what
of
I said was there's a fantastic YouTube video we've done on it, and also an article, and it's a great way of moving assets without triggering paying capital gains tax.
Sorry, I'm going to have to share this with Asma, who's a brilliant accountant working with us from time to time. Says, hey, hi both. We can see you clearly now. Louise,
you are so lovely.
What about mine?
You got lots. They're not hidden.
And not only that, I've got a black eye because of Louise. So
I haven't
just putting
given him
I'm
a black
just
eye.
putting that out there now for you to smash that like button in sympathy. Okay.
I commit to you, I did not throw a calculator at him.
Let's get on. So,
even though I might have been sorely tempted at times.
Here's probably one of the most interesting questions of all of the shows we've ever done. I like these questions. It says here, if you open a business in a tax haven, right? So let's go with Dubai because that's easy.
Lovely.
It's a certain legality and residential status, i.e. you have a resident of the country to benefit from tax exemption. Now, let me get started on this one because
He's getting started. Stephanie, I'm warning you, he's getting started.
Yeah, I'm getting started. Let's get the party started. Get the balloons and the poppers.
Hooray!
Yeah. So the idea behind it is if you have a business in one country and you do trade in another country, let's say UK, and you buy property in the UK, as an example, you would actually still be taxed in the UK, even though the company is in Dubai. So don't just be fooled by someone saying to you, set up in Mauritius or set up in Monaco. It'll be totally tax-free. No. Those days have long gone, and HMRC and all the kind of galactic costs of tax regimes like the IRS will tax you no matter where you are. So it doesn't matter about the company. It matters more about you as an individual. So as an example, Louise and I were talking about, well, should we move to Spain? We were even thinking about, well, actually, could there be a nice tax incentive to my business to Gibraltar? And categorically, well, where's your business conducted? In England. Well, that's where you're going to be taxed.
What you need to think about is an old style Latin rule around what's called situs, S-I-T-U-S. And it's basically, where is the asset cited? If it's cited in a particular country, it's highly likely that that tax of that country is going to win out in terms of how the assets profits are taxed. There are a small number of scenarios where that doesn't occur, but they are a tiny portion of the reality of the situation. So without repeating everything that he's just said, quite frankly, Stephanie, you have to be careful that if you're being sold something that will enable you to be taxed in a very tax efficient location, just be careful, because it may fall foul of the rules set up in most countries where you're actually based or where the asset is based, and they'll still get you. And
there's lots of reporting going internationally now as well in terms of where money's been transacted through. You could actually be causing yourself issues with VAT, customs, things like that could all be a bit of an issue for you. So do get some tax planning. It's more about what, as we said earlier, we're going to Spain, we're paying more tax. So ultimately, you have to do what for you first and then think about the tax consequences or tax benefits. What you've described, having a business in one location, but you're still working in another, that's not going to work. Yeah, have a think about it, maybe restructure. I had a call yesterday with someone who was going to be working in Pakistan, and the idea behind it, I was trying to force him over there to say, well, actually, you could get some really good tax write-offs over there. So why don't you just go over there? He didn't want to, and I tried to force him. I just thought, it's all about, doesn't it? So
it's not me that gave him the black eye.
It's a client.
All I'm saying.
Yeah, it did happen. Right, so let's get some live questions, shall we? So I'm just going to flick through, and we may have some. Oh, well done. Here we go. Let's just go to this one because I've not seen this one. Martin.
Hi, Martin.
Is it worth forming a limited company for a single property deed of trust? How does it work, please? I mean, they are very different things. By the way, I'm just going to connect the two dots here because I've seen this on a recent article whereby someone said, well, why don't you do a deed of trust from your personal name to a limited company in close connection? And that, again, really now does fall under GAR because you're trying to get a tax advantage in a company rather than the common person, as it says in the legislation, or common man. I think it's quite sexist. I know. But yeah, so you don't do that. I'm connecting the dots. I'm not saying you're saying that. But, just in case you're reading some stuff. But is it worth having a limited company single property?
I'm going to sound again like that awful politician. It depends. If that property is multi-million pound, property, residential dwelling property, maybe. If it's not, if it's a small property, pulling in perhaps a few £1,000s worth of profit, I'd say think very carefully. Partly because, of course, a company needs to be, I always think of it a little bit like a baby in the fact that it needs to be clothed and fed. These things aren't cheap to run. And I recommend to my clients when I talk to them about limited companies that it's going to cost you on average on an annual basis, whether you make money inside it or not, anywhere between £3,000 to £5,000 a year. If your profit from that property is less than £3,000 to £5,000 a year, gosh, don't do it. It doesn't make sense. If it's the start of an aggressive growth plan where you're going to load more and more and more properties inside, well, you've got to start somewhere. And so perhaps a limited company is the right solution. But I would say for all the client conversations I have where they start with, well, the answer is a limited company, Louise, isn't it? I would say less than 50% of them actually, once we've had a detailed chat and understand the tax position, realise that it probably isn't the right solution for them. It isn't a solution at all. It's a problem waiting to happen if they were to do it.
I'm just wondering, just curious, because again, I'm more focused on the pixel now than I am on this show, which is really bad and unprofessional. But could you just drop me a comment to say you look? I was going to say you look great, or you look pixeled. Could you just write a comment if you're watching this? Just let me know live. I am obsessed. I'm just not happy. I'm not happy about the quality.
I'm so sorry, people. Obsessed.
This is a premium quality show, and I don't think that Shell, the broadband provider, should be letting me down.
You've not mentioned them
at
all before.
No, absolutely outrageous. So if someone works for them, shame with yourself. Right. So let's go to Stevie. Stevie. Let's go to that question.
Hi, Stevie.
So Simon, 10 years ago, I made an irrecoverable loss. Now I had to put my teeth in for that one. I always get those words mixed up.
You do.
To a trader, namely a director's loan to my own limited company. The co has since ceased trading. Can I claim the loss for use against my impending
CGT?
Yes, it does say that. I ain't got my glasses. I'll be Mr. Magoo right at the lens in a second. I'm going to go on to the first section, and then you can go cover my back.
Go for it.
Okay, so if you have bought shares and then those shares have gone wrong, as in they've lost value, then if you bought a share at £10 and now they're worth £0, then you can indeed get a capital gains tax loss.
It's called a negligible value claim, NVC. Some very specific hoops you have to jump through in those instances.
Isn't that an online shop? That's QVC.
Oh dear. Sorry, Stevie.
Get some good lawnmowers off.
Keep going, mister.
So that's all I was good to say, is that capital gains tax, you get loss. But if it's a loan,
sadly, loans don't fall in that negligible value claim same basket.
Doesn't work.
No.
It doesn't work, unfortunately.
And also, if it's made you start thinking about, well, are there shares that I invested in that have now lost value or have ceased to trade, you must claim the negligible value claim inside your self-assessment tax return before they are dissolved as a business, and therefore the shares are no longer in place. So sadly, you can't go backwards a long time ago. The business has to still be live, albeit perhaps limping, to say the least. And there's, as I say, quite a lot of conditions you have to meet. So go talk to your tax advisors about that, in particular if you think you might have an NVC.
Apparently, we are slightly pixeled, which makes me a lot more attractive.
Excellent.
That's me saying that, not you before you say it. Right. So let's crack on with the questions. I have now lost myself because I was going.
You have, haven't you?
I have. I'm just going to go into the questions. So thank you ever so much all for joining the show, by the way. It's really appreciated.
Have you subscribed yet? Have you clicked the like button?
Yeah.
We all like to be liked. So if you haven't and you like what you're hearing, please just take a moment and click it. We love that feedback. That really helps us.
So that's there's a men's magazine called FHM. Oh, sorry, FHA.
Oh,
sorry,
stop it.
I did get my glasses out there, didn't I? So FHA said I loaned a sum of money to a property company through my personal account. I'm getting the money back with a fixed return. What's the best way of it coming back to me to avoid 40% tax on its profits? So do you want to just make a start on that from a self-assessment queen?
Okay, so I loaned a sum of money to a property company and I'm getting it back with a fixed return. So I'm guessing what you're saying is getting the capital returned and some interest.
Well, let's just focus on the interest.
Yeah, I'm just about to.
Unbelievable, people. I'm so sorry.
Just to be clear. So just for clarity, stating very obvious, I'm sure, the capital portion will not trigger a personal tax on you, nor does it need to be presented in your personal tax return. So I'm really sorry if I'm stating the very obvious, but just want you to be aware of that. The interest, I'm going to call it interest for now because I'm going to guess that's what it is. The interest will, of course, be captured on your tax return because it is an income, and it will be captured no different to how you would record bank interest that's taxable. If you are getting that money back, there's a likelihood that you're actually having some of that tax withheld. So if the company is performing its duties correctly, it should be filing something called a Corporation Tax 61, CT61 form once a quarter. Quarters are based upon the year end of the business, not, if you like, annual quarters that you might think of in general for a calendar year. And it has a responsibility to typically withhold 20% of that interest and pay it to HMRC on your behalf. So I'll probably send you over the edge with that information, but the interest needs to be captured genuinely as interest on your tax return. Don't ignore any held, because that will help minimize your tax. And depending upon which tax bracket you're in, you might find yourself able to earn up to £6,000 of interest a year tax-free. Most basic rate taxpayers can earn £1,000 tax-free, and if you're a high rate taxpayer, you can earn up to £500 a year tax-free. So, and those are taxable interest. So ignore your ISAs, etc., because they don't get taxed no matter what. But there's an opportunity there, and you should be exploring it as widely as you can if you're not already maxing out those numbers.
Yeah. So one other thing on that is the fact that if you're husband and wife, so partners, why not split the loan between you? And then you can each get the £1,000 for basic rate taxpayer interest free and £500 as high rate taxpayer tax free. So you could double your money.
I've just said that, people. Have I not just said that?
I'm just emphasizing it for those, because you know,
tell him off, people.
I speak more.
Tell him off.
Right. Not only that, but what I do want to emphasize the point on when people talk about this, Louise quite rightly talks about tax-free, and therefore it almost feels as though that's a cut-off, as in don't charge the company any more interest than that. But I don't think that's the case, especially if you own the limited company. Why do I say that? Well, in the future, in the not long distant future, in a galaxy far, far away, you will have a corporation tax liability potentially of 25%. So if you are a basic rate taxpayer, you could charge your limited company, let's say £10,000 of interest, provided it's 6% or of the total loan. Don't try and rip the company off, because HMRC don't like that either. But as long as the interest charge is 6 or 8% typically of the outstanding loan, then you can charge your interest. Why I like that £10,000 as an example is because as a basic rate taxpayer, you will be taxed at 20%. We know that part of it will be tax-free, but most of it will be taxed at 20%. But your limited company gets potentially in the future, depending on your profit, 25% tax relief. Okay. Now you're probably thinking, what's this guy on about? The corporation tax is only 19%. If you missed that video about the tax rate that's going up to 25%, that's another show, I think. But you know, so do have that thought. Even at 19%, you're only paying really 1% more tax, but you're taking the money out of the limited company. So I do say to all of our accountants, look at the limited company, how much profit is in there, look at your personal self-assessment tax return, and see how much more interest you could actually charge. The fact that you don't take the money out, as long as you charge the interest out and you loan it back to the company, then your quid's in. Any more comments to that?
I have one extra thing that's going to blow your mind, FHA. Have you borrowed the money personally in order to lend it to your limited company? If you have, you may find you're about to get even better tax relief. There is a piece of legislation that allows you to expand your personal allowance to a degree, the way I think about it, by the amount of interest you're paying out personally on the loan that you've taken personally that you've then lent onto your company. So it's basically a piece of legislation about qualifying loans. If you go Google HMRC qualifying loans, you'll find a fantastic help sheet. So genuinely, if you have you've borrowed the money yourself, you've then lent it onto your company and you meet certain conditions, then again, you're going to get that qualifying loan relief, and it will expand and broaden your horizons as to how much interest you can receive from a company very tax efficiently. Moving on.
Yeah, moving on, just looking at some interesting questions. And by the way, as much as we do look like Minecraft, please do subscribe to this channel. Please do like this show, because it does help with the YouTube algorithm. And we hope that you're getting some really good value out of it whilst being entertained at the same time. So let's go to this question. So Saskia's asked a question.
Hi, Saskia.
as an SA manager, can I help my client's landlord with capital allowances and mortgage interest offsets? That's an interesting thing. I would say that if you're a manager of a property, don't get involved in tax. Simple as that.
Point them in the direction of someone you feel can trust to help them.
Yeah. And I'm not trying to just be dismissive, but if it goes wrong, it's on you. And that could really damage your reputation, and taxes can be quite difficult to understand anyway. So my answer to that is probably stay away from that side. Newbie. Now,
hello,
my
newbie.
son would love you, because having a noob as a name is something he would be laughing at now. He would. My husband and I registered a company to do buy-to-let and flips. Now, that's interesting, because you said, I have registered a company. Ooh, to do both? Not advisable. Not advisable. And I'll tell you why. Let's imagine you have a property that's an investment company. You have a limited company that holds a property investment. Then you buy a property to develop, commercial to residential, as an example. Then something goes wrong and someone dies on your site. What happens to that company? All of the assets will be at risk. So please, anyone listening to this, do not mix a secured, safe business with something that is more risky. Yeah.
And I know it sounds a very extreme example, but it happened. It happened to one of our clients. They lost everything, and someone lost their life in the process, which, you know, you don't want to think about ever. But sadly, because all of the eggs in one basket, everything was at risk in the litigation, and everything went. So you have to be very careful. Some of my clients do talk about, well, I'm just testing, you know, I've got a great buy-to-let portfolio. I'm just testing the water on flips. Perhaps one flip in your buy-to-let company if it's likely to be low risk. But even then, I would want you to think very carefully about that. There's also the issue that mortgage companies are lending money to the buy-to-let side of your business could get quite uppity. There's another one of my technical phrases for the night. You've had pot and uppity now, but they can get quite uppity if you're starting to mix other types of business in with the same rental business. And in fact, if you look at the conditions on your mortgages, you may find that these conditions very explicitly describe that the business in which the money has been lent must only do one type of activity, which is rental. So you could find yourself suddenly breaching conditions of mortgages if you're not careful.
Just out of interest, I'm really intrigued as well, because we're trying to make this a business and property tax and investment show. So I'll be really intrigued to know if there's any business owners or investment. So maybe just use the word business or investment and just type that into the chat box, just so I've got an indication of who our audience is, because I'm trying to tailor our answers to the most suitable audience. But equally, it'd be quite to get some business related questions as well as property. Let's go to one question here. Hi, looking to as a joint venture commercial to residential, which is what I've just said actually. Is it a limited company structure required? Thanks. Back to our point earlier. If it's risky, which commercial to residential is, certainly is. What structure you need, what really does depend on what we said as well earlier about the tax efficiencies of the individual owners, because it could be, just on this point, that you could have a limited company, and who owns that company? Is it another company you own, or is the company going to be owned in your name? Any thoughts?
Answers on a postcard, please. Back to Simon's point around that wonderful apex predator triangle that he described. Perhaps you have a holding company that oversees your share of different limited company activities. The issue we tend to find, and it's a non-tax point, Ray, is that the more layers you have in your limited company structure, the fewer funding options you might be available to benefit from. So commercial lenders, high street mortgage companies tend not to like, if you like, a holding company structures. They don't understand them. I don't think they're that complicated, but clearly they feel they are. And so you might suddenly find your lending list is a lot smaller than you would like. So all sorts of practical issues to think about, as well as kind of risk mitigation. And then, you know, ultimately tax is not just the only thing to think about.
No, Indeed not. Okay, let's go to some of the questions that we've had. So I'll just skip past that by mistake. What a stupid child. Here we go. So the Pamela.
Hi, Pamela.
Pamela, thanks for the email, by the way. I just recognize who you are. So Pam has asked this question on an email. So, but I'm glad that she's come onto the show. Are properties because of Section 24 and paying tax on my mortgage payment? So is it worth paying off the mortgage as I am paying tax on money I'm not getting? And the answer to that is depends, really.
Oh gosh, now you're sounding like a politician.
Let's sit on the fence. Splinters of them.
So we because we love tax, we had a session not so long ago with all the key members of team looking at tax angles on this, and we came up with, I think it was in excess of 20 strategies you can follow. Some of them are sole things that you must do, and you can't then consider any of the other 20, and some of them you can basically combine. 20 strategies you can use to minimize the impact of Section 24. So ideally, one of those strategies is indeed paying down the mortgage in the first place. And if that's something that you're considering, well, maybe that's a great thing to get on with and do. But that's not the only thing you can be doing. Some of the strategies that we looked at made small changes for people. Some of them made huge changes and minimization of the Section 24 impact. So the one you're suggesting is just one of many. It's a great one. And if you can start to pay that mortgage down, awesome. Make it happen.
And one thing I'll say as well is we talk about mortgage interest rates going up. I did a video today talking about the economy, which is going to be released in the next few days. And in that video, I talk about inflation. I talk about interest rates. So it's more of a global economy perspective video. But in that video, I talk about the interest rates, the fact they're over 1%, they could get to 2, could get to 3. Mortgage interest rates could go to back to 5, 6, 7%, which would be unheard of for the younger generation. So, you know, at that point, I would be saying to people, well, how much return on investment do you make? Bearing in mind you've got tax to take into account. How much return on investment do you make? And people always say, well, you should do this thing called buy, refurb, refinance, rent, refinance. The problem is with that is that you're increasing debt, and in times when interest rates are high, I would actually say that's the wrong thing to do, because the Section 24, you don't get the tax relief, and more importantly, you've now got all this interest going against you, lowering the amount of profits, and then all of a sudden you could be into a loss-making situation when you take tax into account. So should you pay off mortgage? Maybe, but I think it's depending on your situation. What I often say to people is, well, hold on a minute, could you give up your job? You know, do you need your job anymore?
Strategy number 2.
Strategy number 2. Strategy number 3 could be, well, you know what, convert it to service accommodation, holiday lets.
Because help sheet 253.
You got to, but you got to research these things, haven't you? That's exactly the thing. But I'm just giving ideas, Louise.
I'll let you off then, Simon.
Right. So if you saw my pixelated shrug of the shoulders, like, because I'm on Minecraft right now, I should be able to get an award for this Minecraft show. Right. Okay. So let's move on.
Ender dragons available. I could do with one.
Enderman. Right. Regarding, by the way, if you're thinking, aren't they sad watching Minecraft? Our son is only 7. Okay. So just leave it there. We have to watch that. And Presley. So if you're watching Presley, Preston, Priestley, if you're all watching, give us a thumbs up. Doubt it. Right. Okay. Regarding Rex question.
Is that Sam? Hi, Sam.
Oh, sorry. Yes. Regarding Rex's question, can he use deed of trust and put the property income to his wife's name? 1901. Yes, you can. You can always.
You've been watching our video, Sam, haven't you?
Stop showing off. You watched our video.
Well done, you.
Give us the credit.
Well done, you, Sam. Yeah. Absolutely.
But you can do that. So yes.
Go watch our video on that. We've got an awesome video on that if you haven't already watched it, Rex.
Yeah, plenty of videos about deed of trust. We've probably got 10 videos on that now. The big thing for that deed of trust side is make sure you're conveying to does it properly. And if you own the property 50-50, don't forget you need to do a Form 17, which then needs to be sent to HMRC with a copy of the deed of trust for them to acknowledge it and accept it. There are so many conveyancing solicitors and so many solicitors out there They will do the deed of trust, but it becomes nil and void because you haven't sent it off to HMRC
within a set number of days as well
60
from
days.
executing the deed.
So yes, so there's plenty to think about there. Let's just get onto it. I can see you yourself. So I just getting through all the compliments. If you haven't done the compliments, please do so. We do like reading those. So let's just go into registration.
I'm a bit pixely. Oh, Paul.
Yeah.
Well,
Alan Force, may the force be with you.
Hi, Alan.
Is it possible? I bet you've never heard of that one before, have you? Is it possible to create a company in relation to rented properties when someone is already a sole trader or a personal taxpayer? I think we've pretty much covered this, haven't we? To say GAR.
So if you're thinking, if that's kind of leading back to my rent to rent point, then Alan, I think that's a route not to consider. Like I said, there's a very small handful of organisations that can do this without falling foul of GAR, but you can a lot of hoops.
Yeah. And if you're not as agile like I'm, you'd just fall over. Okay, so let's just go into another question. So here's a question. Let's have a look at this. Tim.
Hello, Tim.
Tim has asked, good evening. My father-in-law has just signed his home over to his daughter. Okay. Father-in-law, sorry, yes. Has transferred the property to his daughter. Would there be a CGT for her? Yes, potentially. Should we now in place of a trust filter? I think there's two parts of that. Father gifting a house to his daughter is a CGT. If it's a home, marital home, then again, back to our point earlier,
PPRR might apply. I'm just nervous.
Nervous?
Tim.
Why are you nervous?
I'm always nervous.
Right.
I'm just nervous, Tim, that father-in-law could still be living in the home. If he is, there's again lots of lovely pieces of tax law that say, well, actually, technically, he's not given that way, and it won't now fall out of his death estate in 7 years' time. In order to enable that, you might need daughter to receive rental income from father-in-law at the market rent, which means that daughter-in-law is now going to pick up tax on that rental income, but you need to protect the asset move if father-in-law is still living in it from ending up being in father-in-law's death estate. Hopefully that's a very long way away. But simply handing over the deeds to someone else and then remain is not a great outcome. You need to go research something called reservation of benefits. So just be careful with that. Go get some tax advice.
And there's lots of court cases going through whereby people have thought, well, I'm going to gift my house to my daughter, whether I live in it or not. Sometimes, if you have some sort of holdover property, then it will always be part of the estate. So you may have paid capital gains tax, but it's still there for CGT.
Gift with reservation of benefits. Gift with reservation of benefits is the thing to go research.
I want you to read something for me.
Oh, no.
Read this.
Okay. Saurab. Hi, Saurab. You both sound good and look. Oh, you are lovely. Thank you, Saurab.
Yeah.
You're very kind.
It's pretty. Even the food in my teeth can't be seen on this microphone. It's great.
Even your wooden teeth.
Wooden teeth.
Yeah, amazing.
Okay, so here's a question. Actually, this is an international. I do like international questions.
Hello, Truth Observer.
Is it true you can move to Portugal? You can.
Oh, keep going, would
you?
Yeah,
sorry. And rent out your buy-to-let properties in a limited company without paying dividend tax. And if how long does one have to reside in Portugal? We don't know about Portuguese. If you ask me about Spain, if you ask me about America, if you ask me about Hong Kong, I'd answer that. But when it comes to Portugal, no Scooby, I'm afraid. Now, what you don't talk about here is the fact that a company, if you own properties in a company, would still be subject to corporation tax because it's a UK company. And even if it's a Portugal company, it would still be subject to UK tax. The asset is cited in the United Kingdom. So the fact that you pay corporation tax already, and then you pay dividends over to yourself in Portugal, get some Portuguese tax advice if you're going to be out there. I did, funny enough, talk to one of our clients to move over to Portugal for inheritance tax benefits. So there's a lot of tax benefits of moving over to Portugal, just not as nice. Well, I'll be careful here. It's just as nice.
That?
Sorry, Louis Vigo, if you're watching this, good old mate. What? So if Portugal's lovely and I like it there, it's just not as hot as Spain. That's what I was about to say.
Oh, it is too.
No, it's not.
It is too. Anyway, just before we move off, Truth Observer. Just to come back to some basic points, if I may, given Simon glibly skimmed across them. Typically, if you have dividends from a UK company and you're not residing in the UK, then it's unlikely to collect dividend tax, as in you're personally not likely to collect dividend tax if you're not UK tax resident, working your way through the UK tax resident rules. But to Simon's point, that's great, and you might be whooping with joy. But actually, if the Portuguese tax on dividends is more punitive than British tax, then actually that whoop might last a very short period of time. So I'm guessing you've probably done some research on that already. But actually, if you are receiving dividends from a UK business, then the likelihood is they won't be taxed here in the UK. They'll tax wherever you're based.
Let's move on from this. By the way, there are 42 people on the show watching, and there's only 26 likes.
What?
Which one of you? Come on. Which one
of
honest. You has not pressed that like button or the subscribe button? We know who you are.
We do. We do.
So, and equally, who's not shared this, link to this show with their friends? We should be seeing hundreds of people on the show now. How dear. So,
hello, Keith. So, great session. Thank you. Is interest charged on finance for a building that you own but is let on a R2SA? So, rent to serviced accommodation is what I'm thinking. Still subject to Section 24. I have nothing to do with the serviced accommodation operator. So, you have to look at HS253 conditions. I'm sorry, I'm going to get quite technical for a second. So go Google HS253. The first thing you need to bear in mind is that Section 24 is applicable unless you meet those conditions. So in other words, you personally need to be renting it out for at least 105 nights a year on lets of 31 nights or less. You personally need to be presenting it for rent at least 210 days a year. And you personally cannot be letting it on longer term lets of more than 31 nights for 155 nights a year. Sorry, I've thrown a lot of detail at you there, Keith. I do apologise. Actually, the only person who's benefiting from that deal is the serviced accommodation operator, not you, because your deal with the serviced accommodation operator is likely to be on a long-term rent or long-term lease, which of course immediately doesn't then meet all those HS253 conditions. To just add salt to that wound, I'm so sorry, the SA operator is probably getting no benefit either from that Section 24 for no better reason than they're not paying interest, are they? So they don't have to worry about Section 24 whether it was operating under the HS253 conditions or not, because they're not paying out interest. You are.
Very good answer there, Louise.
Thank you, Simon.
Made that quite official. Okay, let's go to another one. Ramsey.
Hi, Ramsey.
Not Gordon.
Oh, stop it.
Gordon's right here with all these. You can't see it on this Minecraft session.
Can you know what?
Bless him. Beneficial.
Okay, can you claim additional SDLT refunds if you're replacing your main property, even if you already own buy-to-lets? Let's answer that first. Yes. So you might not even have to get a refund. You might have to pay the additional 3% rate if you're moving straight from one property that was your home to a new property that's your home, so long as you only own one of those at midnight on the night you buy the new one. Again, sorry, I'm going a million miles an hour. If, however, you were not able to sell your prior home before you buy a new one, but you do sell your prior home within a certain timescale, then you can indeed, as you've expressed, Ramsey, go and get that stamp duty land tax refund. Next question. I plan to stay in my current property for 12 months. Do I need to register with HMRC? So you need to make sure HMRC know it's your home. Back to some of the examples we gave earlier of principal private residence relief. You can only have one home, and that is the one in which you elect. And every time you buy a new home, you have 2 years to elect which home is to be your principal private residence. So if you do want to make sure you're capturing these correctly, it sounds to me like it probably does need to be confirmed to HMRC.
Perfect. Good answer. I'm sitting here quite lazily. It's nice. Right. Oh, how do you say
Trickles.
trickles? How do you
Hi,
do that?
Trickles.
It's amazing how you do that.
Hello, I have a limited company with 3 properties making 6.5k per month. Now, is it profit for show? Sorry, I'm going to get this wrong now. Turnover for show, profit for dough. There we go. Which one of those is it? I also have a property under my own name making 2.8k per month. Is it worth putting this on my limited company as well? Oh, that's a lovely question, Trickles. Typically, when we look at this kind of scenario for clients, the payback period that we're interested in is how long is it going to take before you start to benefit from lower tax rates in a limited company compared to the higher rates of tax you might be paying in your personal name. We need to take into account the cost of transferring that asset across. As you're probably aware, if you move an asset to a limited company, you're going to pick up capital gains tax on you personally, and your limited company is probably going to pick up stamp duty land tax. So you need to take all those things into account. More often than not, when our clients look at those numbers in the current marketplace, the payback period is 12 years. Not a great solution. So you might need to do some real number crunching to understand what could be the capital gains tax bill if you move the asset. Bearing in mind connected persons, you need to know what the market value of the asset is today to work that out. And of course, you also need to work out that value for the stamp duty land tax to your company. So lots to think about there.
Perfect answer. Again, I'm sitting here quite lazily. It's nice. I'm just the hostess, the mostest.
Hello, Mike.
She's taking over the show now. You are just getting on a roll. It's my turn to ask.
We're fighting over you, Mike. We're fighting over you.
Mike,
in a good way. Not a good way, just in case you're going down Paw Patrol route. Again, so old, sorry.
So, if I use a trust to gift a property to my daughter, would she ever become due if she lived in the property? Well, depending on the type of trust, I would say. So if you do put an asset into trust, you could avoid capital gains tax, but you might have to pay inheritance tax. So you do need to think about that. What I always think about, because there's lots of people asking about gifting assets to children, and I totally understand it, but you do need to think about a few things here. Stamp duty land tax, if you're getting any form of money, even if your children are paying off the debt, then that will be deemed to be consideration, and therefore stamp duty land tax will have to be paid. In addition to that, you've also got this whole thing about capital gains tax. If you're gifting a property and receiving no money, you still have to pay capital gains tax for someone who's close to you, as in father, son, or mum, daughter, that kind of combination. You also have this whole thing of inheritance tax, because even if you do gift it, it still could be considered a pet, as Louise said earlier. Within 7 years, it could be clawed back. Using a trust can be very costly and very complicated to do, and but it can give you a huge benefit from saving from CGT, but it reduces your inheritance tax lifetime allowance. So just bear all of those things in mind whenever you're doing tax plans, and get a tax consultation with us, because I think our calls are now like £125 or something like that. If you use the code YouTube20, you get 20% discount off those tax consultations. We're talking about £100, guys. It's not a big deal of money to get peace of mind.
And it can save you thousands.
It will save you thousands, I've no doubt.
As well as, hundreds of sleepless nights as well, worrying if you're doing it the right way.
Yeah. I'm just going to go to this question. I think I'm just missed it off. No, it's back to there. It's this
We've already supported Trickles on that one.
Truth Observer is back. Yes. So if you buy a property to flip in personal name, no. Let's just stop on that, shall we? This is a huge mistake. So if you've already been listening to us, risk, right? The first and fundamental, I forget about tax for a second. Just think about risk. I know you're going to get upset.
Shocking.
I know HMRC are going to get upset, but you're not important. Hold on a minute. You are important, but your thoughts of tax are digging hole. So
would you like a spade with that, sir?
No, not today.
No?
Tomorrow.
Okay.
But flipping properties in your personal name, if it's risky, then you're going to be in trouble, because your assets could be subject to liabilities. You might have to give everything away. So please don't do that if you do major developments. And that's not just for Truth Observer, that's to anyone listening in. If you're doing a small refurb, then maybe you could do it from a risk perspective, but what taxes will you pay?
Oh, I'm so glad you asked me.
Oh,
I'm so glad you asked me. So if it's in your personal name, you're obviously going to pick up income tax on the profit you make. And that depends on obviously which rate you're at. Most people who do flips in their personal name that we've seen for our clients, they end up doing a fabulous job of it, and they create, lots of profit, and they end up paying 40% of it out in income tax. Not nice. And just to add insult to injury, then you've got national insurance on top of that as well. Self-employed national insurance. So kiss goodbye to another, 12% very approximately. So you're actually kissing goodbye, if you're a high rate taxpayer, 52% of the money you've just made. No, don't do it.
Yeah.
Please.
And in a company, what you have to bear in mind is that if you put it in a limited company and you flip, don't do what some people do. And again, I'm going to do a video on this called TAR. What is TAR, Louise?
Targeted anti-avoidance rules. I do love my TARs and my GARs.
Very teacher-esque tonight, if you don't mind me saying.
Am I?
Yeah, very kind of, straight there. Why is that a problem? I mean, it's great that you gave the acronym, but, it's a bit boring, isn't it?
Yes.
Tell people what it means.
TAR basically means if you close down a company and seek to benefit from some tax release, which you can do potentially at closing of a business, then unfortunately, if you then start up something same or similar, and I'm not going to be drawn on what same or similar means, because in fact, HMRC haven't been drawn on that either. They've just left it as same or similar, and you start up a business or you're already acting out a business, same or similar, within 2 years of closing down the other one, they'll come back, they'll knock on your door, they'll demand income tax instead of corporation tax at the closure of that business, which, back to my original point, could be anywhere of 40% up, plus they might then be kicking on your door for national insurance. So, anywhere from potentially 52% as a combined tax bill up to 57% if you become an additional rate taxpayer based on the proceeds you made out of the sale. Not a great place to go.
No.
And you could have prevented that from happening by not closing down the company and instead extracting the money made in that company tax efficiently over a short period of time by all sorts of strategies that we could talk you through.
Just out of interest, guys, I'll be interested in your views on that. Again, please don't ignore my questions. Please do comment. It's nice to have a two-way conversation going after all. But do you think there's going to be the R word? What do you think R word is? Recession. Do you think there's going to be a recession? Just type in yes or no. That's what I want. It's like a poll, a mini poll. I'm Polish, but I'm not me. But put your words into the I want to just see if you think there's going to be a recession. It's a huge debate at the minute. People saying there is, that there isn't. America apparently is already in, but just not willing to admit it. So yes, tell me what your thoughts are. Let's go to FHA. Back to FHA. It was saying, wow, so me being working man wanting to open up a company doing rent-to-rent business is now difficult. No, hold on. Rent-to-rent on other people's properties is fine. Doing rent-to-rent on your own properties, that's not fine. Just for clarity. Okay, so rent-to-rent on other people's businesses, on other people's properties, absolutely fine. Don't worry about that.
What I would say is, depending upon where you are in the country, you might find that you've got to jump. I like my hoops, don't I? I'm so sorry. But you may find you have to jump through quite a lot of hoops. So an example recently that was shared with me was Scotland have some very, very, very strict laws about individuals who can let out properties on behalf of others. And if you don't meet criteria, if you don't complete the exams that you need to, they can start fining you at £30,000 or more. So rent to rent, arguably you could say it's not actually rent to rent in that scenario. What you're doing is you're becoming a letting agent with additional services, and you may fall into a bracket that requires you to meet certain criteria and certain qualification standards that a letting agent would too. So FHA, hoping that's helped. I feel like we've taken you out of the frying pan and then we've put you straight back in the fire again. I'm so sorry.
I'm going to go and answer this question, which says, what is the estimated cost for setting up a group structure, please? And what I would say on this point is, think about the price of an item and then the cost of not getting it correct. What I mean by that is, I kid you not, we see 60, 70, 80% of clients come to us with the wrong limited company structure. That's because they use generic accountants to set up their company who doesn't understand freezer growth shares. They've used online platforms, which is cheap. You get monkeys and pay peanuts. Get it? Well, I don't know. So if you have
covering all sorts of pet analogies this evening. Sorry.
But if you use these online platforms, then ultimately you don't get a freezer growth share. So it's not good for inheritance tax. And it won't do it an alphabet share. So you can't even split your money between your spouse and civil partner. So I think from that side of things is we do charge a hefty price. I'm not going to lie to you. It will cost you about £1,000 to set up this kind of structure. Company. Yeah. But I'm sure we can do a discount if it's 3 companies, for instance. Yeah. But we can set up these group structures. But what we do with everyone is we have an hour tax consultation as part of that fee. You can go onto our website about limited companies structures. It's all on there. We're very open and transparent about our fees, but it's a service that we give. So we do provide a service. We want to talk to you. It's not a click, 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 get it wrong. It's a conversation to understand about who's in your family, what your long-term plans are, and then for us to go through that. So I don't want to be a kind of salesperson on air right now, but I do want you to think about, well, I can go down the road to someone, I'm not going to mention their names, but a high street accountant, and they could do it for you, but would they do it right?
Yeah.
We see too many legs.
We've seen examples where an individual has set up a company for as little as £6, and it's then cost them about £1,800 to put right, and they've lost deals because the time it takes to put the company structure back right is quite time consuming with Companies House, and they only have a small team at Companies House that deal with that particular issue, and the seller that they were looking to buy from is not willing to wait around and has gone off and done the deal with somebody else. So sometimes it's not even just the ramification of you haven't got the structure you want. Sometimes it's the fact that it now slows you down in getting on with all the things you need to do.
I'm going to do one more question, and then I'm going to do some announcements, and then we can go off air.
Hello again, Babish.
But Babish says, if my business is a beauty training academy, yes, we've got a business tax question.
Non-property, okay.
Hurrah. What?
Non-property.
Non-property. I was going to say, don't spoil my fun. So it's a beauty training company. Is the sales VAT exempt if turnover is over 5,000? Well, actually, it's the other way around. If you got over £85,000, and you have to look back the 12 previous months, by the way. So it's not where you are now times up by 12 is that 85,000. You actually look back. And if you're over 85,000, that's when you have to charge VAT. But it does mean you can claim back VAT as well. So the pros and cons for your beauty, it does mean that you're pushing your price up, and typically your consumers of your service won't be able to claim back that VAT. So you then got this issue of, well, I'm charging VAT, they're not going to accept that, I've got to take a hit on my profits. The answer to that bit is yes, unfortunately, you will have to do that. So you then make that decision of, well, what do I keep on pushing growth, or do you actually relax your business back and just keep it under that 85,000 and keep the more of the margin? Really does depend. I would always say push on, be VAT registered. Yes, you take a hit initially, but keep on growing that business.
It's a great business, and it's already at 85,000. Keep going, Bavish. Sounds fab.
So I'm going to stop there because next month's show we've got a very, very important guests, in fact. So who are those guests?
That's a very good question. Why don't you tell them? He changes it on a weekly basis, I tell you.
So it is August. So James Morley, David Hanna, if you are watching, then please make sure that you're on air next month. Okay, because you're live, you're with us, talking about stamp duty and land tax. These guys know everything that there is to know about stamp duty,
all the
land
important
tax,
stuff,
and refunds as well. So if you've overpaid tax, they've even got through about pensions and so on like that. Now, obviously, this show is not normally a U-rated program. Trust me on this one, it will be a 15 next time around. So there'll be language.
The air will be thick with stamp duty, land tax.
Yes, and language that you need to put earmuffs on your children so that they don't hear David Hanna. So please join us for that next show. If you have not already, please do press that subscribe channel.
And
please
click the like.
share it as well. Please share this program for next month. It should be the 3rd Wednesday of next month. It's really important for us to kind of get that across. I just realized something.
What have you realized?
Yeah, it's the fact that we had 40 people on our show. It's just nice.
It's lovely.
Yeah.
We like spending our evenings with you.
Yes.
I hope you've had a fun time with us talking about tax. Tomorrow, when someone says, what did you do last night? You're going to say, I was on a webinar with someone talking about tax for over an hour. And they're going to go, oh my gosh, how did you put up with it? And you're going to go, well, let me tell you, they're a bit mad. You've got to join them. You've got to watch them next month.
Got to watch them. Put down Coronation Street just for this one time, if it's on a Thursday. So, yes, on that point, just some of the answers, funny enough, people have been saying about yes and no's, okay, about are we in recession? And I would say that it's fairly split.
Oh, it is, isn't it, as well?
So about maybe 55%, 60% saying yes. But it's interesting, isn't it? Do we all think that recession is perception that then comes reality because we talk about it? And I just said this to someone on YouTube, funny enough, who asked the question saying, well, you'd be stupid enough not to think we're in recession. I don't think he used those harsh, but I think it was along those lines. And my reply was, well, recession doesn't help. It doesn't do it by itself. Recession is driven by behavior, which is us humans. We can actually make this a recession because we believe it's a recession and therefore make it happen, or we just act properly and get on with it. And then we'll get through whatever crisis. Do you agree with that? I'd be interested to know your thoughts on that one. But I think that's pretty much how to. So I'm just going to say FHAs come on. They say, I'll be honest, you are too. Let you read that. My eyes are gone.
Oh, okay. So I'll be honest, you two are amazing. The way you have so much knowledge off the top of your head, amazing. I'll be booking a consultation call. Remember FHA. Oh, bless you, FHA.
FHA.
Thank you so much for your feedback.
Top caller.
Love doing this kind of thing. We're very passionate about it. We want you paying the right amount of tax, which, back to my Goldilocks, it's not too much and not too little. It has to be just right. And we're very passionate about making that happen for people. And hopefully having a bit of fun along the way as well.
Absolutely. Until next time, guys, my name is Simon Mashevich.
And I'm Louise Mashevich.
And we are from Optimize Accountants. Thank you ever so much for joining us tonight.
Thank you.